Okay, so hello to all our viewers in on OptimTrader YouTube channel. So today we have a special guest, our Christmas edition, uh, market veteran Kenny Polcari. So Kenny,
How are you?
just a second. Just, just a second. I have one technical issue. We have to resolve this because I'm hearing myself in. Okay. Yeah, I'm sorry for this problem. We're back in business. So as said, Kenny, really nice meeting you. So you're a market veteran. I mean, I won't go too much into your history. I want you to tell us. So if I'm correct, you started your career in 1980 on New York Stock Exchange floor. So tell us a little bit more about your past and also about your current projects and what are you doing at the moment.
Well, thank you for having me. It's a pleasure to be live all the way, to you guys all the way on the other side of the world. Merry Christmas, Happy New Year to everybody. So here's the deal. Yes, it was May of 1980 when I was a freshman in college, 19 years old. I had an opportunity to work on the floor of the New York Stock Exchange as an intern. I did that, and it changed the course of my life. I mean, you guys have never been there, and nor is it even the same place today as it was then. Because all the people are gone, right? There used to be 5,500 type A personalities running around, screaming and yelling, doing all that stuff. And today, there's less than 200 people that work there, and it's really very automated, very 21st century. It's very quiet. There's no more noise anymore. But yet it is the 21st century marketplace, right? But I spent the summer of 80, 81, and 82 there. I was there during the birth of the greatest bull market this world has ever known on August 17, 1982, when very much like today in terms of there was this financial crisis happening in the early 80s, right after the Jimmy Carter years. He was, president from 76 to 80. He left the country in a complete disaster. When he left, Ronald Reagan became president. Interest rates were 21%. Unemployment was 10%. Inflation was running at 14.5%. I mean, it was a disaster in this country. But it was August 17, 1982, when Ronald Reagan and then Fed Chairman Paul Volcker decided to ignite the fire under the backside of everybody and cut rates by 10%. Listen to what I just said. They cut rates by 10%, which was the equivalent of 2 percentage points because rates were 20% at the time, right? But it was a massive move, and it really ignited what the world came to know as the greatest bull market certainly this country has ever seen. But then it kind of it overflowed to global markets, right? It ignited a real change in stocks and investing in global markets. And from 1982 to 2000, we had this explosive market in this country. I mean, there was certainly bumps along the road. There was a crash of 87. I was 26 years old when that happened. That was an event unlike anything I'd ever known up to that point. At 26 years old, I what did I have? I didn't have much, and I witnessed the complete ungluing of the U.S. capital markets. In 6.5 hours, we lost 20% of its value. Certain stocks lost 50 or 60% of its value in a single trading session. And I'm talking like big name stocks, Johnson & Johnson, right, which makes Q-tips and baby oil, was trading at $96 on Friday night. It closed at $45 on Monday night, lost 50% of its value because people were panicking, right? And people needed to sell stocks that they could versus stocks that they should have sold that they were unable to sell. So that was a very interesting opportunity. It was a very interesting event, and one that, as I sit here and I talk about it now, I can feel myself in the room at that very moment, right? What it was like, the sense of panic that was around all over. And then the recovery back into the 90s and how the global markets took off during, the 90s with if you were a tech investor in the 90s, you were just on fire because the world was then about to enter Y2K and that whole issue surrounding Y2K with technology and computers and automation and GPS systems and algorithms and electric utility companies and airplanes and flights, all that stuff. It was all gonna blow up on December 31st, 1999, as we flipped to the new century of 2000. If the world, it wasn't just a U.S. problem, it was a global problem. And so if you were a tech investor in the 90s, it was an amazing place to be. And then we had the dot-com bubble and burst in late 98 into 99, 2000, where we saw the NASDAQ market over a period of 15, 16 months lose almost 70% of its value. And then we rallied back into 2001, where we had what is now everyone realizes is that event of 9/11, and then what it did to shake not only the U.S. but the U.S. financial markets, but really global financial markets. And there was a reason, and there's a real reason for that a lot of people don't understand, because the United States, is the biggest capital markets in the world. Yet in 2001, we were still trading in a single physical location. Just started the introduction of handheld technology into the process, automated trading, electronic delivery of order flow, and electronic delivery of order execution, all going through this handheld computer when that event happened. And while the New York Stock Exchange itself wasn't one of the targets by default, the New York Stock Exchange ended up becoming a target because we had just switched to initiating all this technology in the 21st century, right, and converting from what was an open cry system, human being to human being, to a technology-based system where the computers are doing all the work. And what was very interesting, and what people didn't realize, and I don't think they realized it either, it was just one of these unintended consequences, is that all the technology that ran the computers and the servers at the New York Stock Exchange, all the cables and wires that connected the New York Stock Exchange out to the world and out to other brokerage centers around the country, and brokers and anyone that needed to access the exchange and the exchange data, all those cable and wires ran out through the belly of the trade center. And so when the trade centers collapsed, all those wires got severed. And when they got severed, the New York Stock Exchange was essentially neutered, right? You could turn the lights on, you could turn the computers on, but there was no data, there was no information flowing back and forth, there was nothing. And so the country came to a standstill, right? From a financial perspective, it certainly came to a standstill from the event perspective, but from a financial services perspective, it came to a complete standstill. You couldn't trade anything, even if you could open the markets, you couldn't trade anything because the communication lines were all severed, and so therefore the communication failed, and that became an issue that we recognized immediately that now this is a problem. And so again, here we were, the largest capital markets in the world, and we were now brought to our knees. Look, don't forget, Europe and Asia, European markets and Asian markets, they had already converted to electronic trading back in the late 80s, before even the early 90s, right? So they were going along trading electronically. So quite honestly, when this event happened, those other markets could continue to trade. We were brought to our knees for 6 days. And when you think about it, 6 days was really an amazing event, because when you think about what had to be done in those 6 days in order to get the place up and running again, right? It was, and that's a whole nother podcast or a whole nother event we can book to talk about, because I could keep you here all day long to talk just about that. Because look, I lived it, right? I was right in the thick of it. My office was actually on the 55th floor of the second tower. That second plane went right through my office. The fact that I'm even sitting here talking to you is really a miracle. But that's a whole nother story. And then one way or the other, after that event, that just lit the fire under the U.S. about using technology to provide security and stability versus just efficiency, right? Because up until this point, we were using technology to create efficiency in order delivery, order execution, order reporting, times and sales data. It was all about using the technology to create efficiency. After that event, suddenly it dawned on everybody that we needed to use technology to create security and stability. And efficiency kind of dropped to the third place, right? So today, as a result of that action, and look, it was probably going to happen anyway, except that event lit the fire under everyone's ass to get it going, right? And so today, the New York Stock Exchange remains as the premier marketplace in this country, yet it is no longer the only exchange, right? There are 10 other exchanges that trade everything. You can trade NASDAQ and listed stocks everywhere now, but there are 50 or 60 different dark pools, which are not exchanges, but they act like exchanges, and they allow you to trade stocks out to 4 decimal places. The exchanges trade out in 2 decimal places. The alternative venues trade out in 4 decimal places. But you could potentially buy and sell Johnson & Johnson and Coca-Cola and Bank of America and Tesla in any one of these places. And so that provides a robust system, because now you can't necessarily bring the system down. If they tomorrow they blow up the physical New York Stock Exchange, is it a tragedy? It's absolutely a national tragedy. In some sense, you might even say it's a global tragedy, right? But they won't bring the U.S. financial system down anymore, because the other exchanges that exist all exist in the cloud, right? They're not physical. They don't exist anywhere. So the servers that run them are located all over the country, California and Kansas and Florida and Maine and Massachusetts and Ohio and Texas. And so if they blow up the New York Stock Exchange, it's a tragedy. But yet those other market centers where the servers are would continue to be able to trade stock. Now, look, it might get ugly. Prices might fall, but you'd get the opportunity to buy and sell. Unlike in 2001, you couldn't do that. You couldn't buy and sell for 6 days, and so there was panic setting in, right?
If I can interrupt you, Kenny, just for a second. There's one question. We are still in around year 2000, and there is one question that I would really love to ask, because there's a lot of comparison in today's world between today and year 2000. So the dot-com bubble that happened and everything. Can we make some? Can we connect the dot plots between those two periods?
You might connect it a little bit, right? When you talk about the dot-com bubble, and all those stocks, by the way, traded on NASDAQ, right? All those dot-com stocks traded on NASDAQ. But there was a frenzy, right? In 99, 2000, there was a frenzy for anything that had .com after its name, right? So whether it was pets.com or clothes.com, whatever it was, as long as it had a .com after its name, it really was on fire. And you saw how the mania for investors to get into some of those names. And, I used to stand on the floor of the New York Stock Exchange where we did not trade those stocks. And I would watch that action and I'd think to myself, this is absolutely nuts, because Morgan Stanley, for instance, would bring pets.com to the market in an IPO. They'd do all their analysis. They'd tell you that the stock was worth $12 a share. And then it would come on IPO day to be listed, and it would open at 150. It would trade up to 300, back to 250, up to 400, and close at 90, all in one day. And it was out of control. Yet it happened over and over and over again with all these .com stocks, which, by the way, produced 0 revenues. But yet the mania about it was a new industry, it was a new opportunity, and suddenly technology allowed anybody and everybody with a computer to be able to access the markets, be able to buy and sell stocks, right? They could do it from their laptop in their car if they wanted to, at their desk, wherever they were. And so created this mania, very much like, I would say, either SPACs this year created mania, or some of these tech disruptor names which create mania. We've seen them stretch to real stretch valuations. During the last year and a half, certainly during COVID, a lot of the names got really, really stretched. And now, when the Fed starts to try to normalize and talk about returning to a more normal environment, we're seeing all these stocks really get hammered, right? Because not only were they stretched to begin with, but then there's this competition for investor dollars, right? Rates go up, interest rates go up, it's going to attract some money away. And where's that money going to come from? It's not going to come from big boring names like Kellogg's and Procter & Gamble and IBM. It's going to come from the names that are stretched, whether it's Shopify or Teladoc or Tesla, or and I'm not saying anything wrong with any of those stocks. There's nothing wrong with Tesla, but maybe it got stretched a little bit, right? Maybe investors, because it was so it got almost cult-like, right, in a number of those names. And so in that sense, you might be able to compare it. I don't think, though, it's exactly the same as the dot-com bubble, because the dot-com bubble, they didn't really produce anything. They didn't produce revenues, but it was I mean, all those companies that no longer exist anyway, right? The ones in the dot-com bubble.
Okay, that's a good answer. But also, what I'm interested. Okay, a lot of those you already mentioned Shopify. Then it's Zoom. Then it's Upstart. A lot of those names already corrected. Like for some of them also 50, 60, 70%. Just a second. But is it possible that this happens also to the FAANGs? Do you think repricing is possible? Some bigger correction, or do
Absolutely.
you think it's?
Do I think now on the FAANG stocks? Do I think Apple's going to correct by 50%? Probably not. Is Amazon going to correct by 50%? Probably not. But do I see a correction in the markets ahead? I absolutely do. You know, I don't think there's going to be the correction I'm talking about in the next 2 weeks before the end of the year. I think they're working very hard at the Fed and the administration to control the narrative, to try to maintain where we are, right? So the S&P's up 25%, NASDAQ's up 18%, the Dow's up 17%. I think that if it stays right here, then they'll be okay. But I think in the new year, when the slate's wiped clean and the Fed really starts talking about, you know, the conditions in this country, the financial conditions in this country, and the need to not only pull back on the taper, but actually start to raise rates because inflation is spinning out of control, that's when I think you're going to see the correction. Now, I think you see a broader correction in the indexes, somewhere between, depends on how aggressive they get or how hawkish they get. But I wouldn't be surprised to see the market start off with, you know, a 10 or 12% correction, and the NASDAQ names might even get hit more just because they're so stretched, right? But in there also creates opportunity. Look, I said it in my note today. Some of these stocks, and you just said it, have already corrected 40 or 50%, right? And a lot of it too, don't forget, we're at the end of the year. So there's a lot of tax selling going on and people taking losses to pair off against gains and all that shit. And so some of these names that have really gotten beaten up are actually entering that very interesting buy opportunity. So we could move into the new year and you could get a stock like, you know, Teladoc or Zoom that's down 50%. And in the new year go, you know, this is a screaming buy. Maybe it is, but you're not going to really know that until, in my mind, you're not going to really know that until you get a better sense and some clarity on what the Fed is really going to do. Because I think what the Fed did on Wednesday was bullshit. I think they talked the line. I think they said exactly what they told us they were going to say, like, yeah, we're going to double up on the taper because we need to do that. But that's what they've been saying for 3 weeks to prepare everyone for that statement. That's exactly what they said. What they didn't say, and there was all the speculation building around it. What are they going to say about rates? And when are they going to start to move on rates? And there was speculation that rates were going to start to move in January and February, which is well ahead of what the market's expecting. But he came out and he did not define it. All he said was, yes, then we're going to have to start talking about raising rates. And he kept the conversation as if the taper would happen first and then the rate conversation would happen. And the market was okay with that. Because the nervousness we saw in the market leading up to that was the conversation that, in fact, tapering and rates were going to happen together, which is exactly something Jay Powell told us would never happen. And then the speculation was, no, maybe it is going to happen. And so that was causing a lot of angst. And the fact that Jay Powell on Wednesday came out and said, no, we're going to do this taper first. We're going to take our time. I think it's bullshit, because I think when January comes, I think he's going to change his tune. And then you're going to hear him say, yes, we have to taper and we have to raise rates sooner than the market expects, which is what I think is going to cause the turbulence.
Yeah, you predicted this on Wednesday. I think you had a YouTube video in which you predicted that this will happen. I'm really interested to see if what January will bring, and I'm also agreeing with you. I'm becoming. I didn't like those growth stocks for the last 6 months or so, and much more. But now, as you said, Teladoc, Upstart, and some of those growth stocks are becoming interested because they corrected so much.
Right, they're becoming interesting. They're still under some pressure. What's the Nasdaq doing today? Actually, the Nasdaq flipped to the Nasdaq was down again this morning. It's now flipped to the plus to the upside. It's up 11 points at the moment, which after being down another 150 this morning. So it's made this little bit of a rebound. And part of that makes some sense because it's down. It was down, almost 9%, right? As coming into this morning, we were down 7.3% on the NASDAQ. It was down another 120 points this morning. So maybe it was down 8%. And so it is, and some of those names are down 30 and 40%. And so some of those names are in fact looking interesting if you believe in the story, if you believe in the thesis, if you believe in those names. And so I do think the market, the market might come under some turbulence in January, but some of the names that have already gotten smashed may not, in fact, they may not run away, but I don't think they're necessarily going to tank anymore. They may just churn for a while.
Okay, that's an interesting point. One other thing, since we're talking about rate hikes, do you think this repricing from growth to value is coming in 22?
Yeah, see, I'm in the value camp. But listen, you also have to understand where I am, right? I'm 60. You're 32. So therefore, your outlook and your perspective and your ideas about where you want to invest your money are very different from mine because I'm on the back nine. I might actually be on the 18th hole right now. You're still on the front nine. So you got plenty of time. You got 35 or 40 years to worry about it. I don't, right? And so therefore, I'm in the value camp for a couple of reasons. A, because I think there is turbulence ahead. And so therefore, I've started to add more defensive type names to my portfolio, but that makes sense for me. A 30-year-old might say, screw it, I want to be all in and you're going all growth and all high growth and all tech. That's great. You can afford to do that. I'm not necessarily at the point where I can afford to have that much of my portfolio with that much exposure. So am I still in the high growth names? Yes. Am I still in artificial intelligence? Yes. Am I still in cybersecurity? Yes. Am I still in cloud computing? Yes. But new money that I'm putting to work now, I'm putting in much more large cap, boring, not sexy names. So it's IBM, it's Procter & Gamble, it's JP Morgan, it's Bank America, partly because some of those are great dividend payers. That adds protection. And they're big Americana mega cap names in their respective industries that will provide some shelter in the storm. Now, you at 32 or 33 years old may say, screw it, I don't want IBM. That's a big old boring tech company. Well, guess what? First of all, not so boring. Pay attention to what's going on at IBM. It is big and it is old, but like so many other companies, the New York Stock Exchange is a perfect example. It has transformed itself into the 21st century. So before you kick me in the gut and say, no, it's so boring. Start paying attention to what's going on at IBM.
No, Kenny, you have to know. But since I'm 30, I'm even younger. But I was born old apparently because I'm in the value camp for more from the beginning. But anyway, interesting take. Maybe we can take it a little bit further. I would like to know your opinion. Especially regarding gold crypto. This Jim Cramer came out a couple of days ago. He said that he would prefer Bitcoin instead of gold. But what's your take on gold? Do you think gold has become uninvestable?
No, absolutely not at all. Now, look, gold has absolutely underperformed this year, right? The GDX is down 20% year to date. But it's at the point where it's starting to build a foundation, and it's starting to churn. And it looks to me like gold is going to start to perform better because gold is absolutely worried about inflation, right? And it's a great hedge for inflation. And gold is always gold. Now, does that mean you shouldn't have Bitcoin? No, of course not. I have both. I've got gold and I got Bitcoin. Bitcoin is a new asset class that, everyone's still kind of getting used to. It certainly needs some more regulation around it. And that's kind of the risk to Bitcoin going in the future, but that doesn't mean I'm not investing in it. But from a gold perspective, I think gold is actually, because it's so underperformed, I think that, there's a good shot if the economy gets as hot as it does and if inflation starts to run away, I think there's going to be an opportunity in gold. I'm not saying overweight yourself in gold or, put all your money in gold. I'm just saying understand that I think there is an opportunity in both gold and Bitcoin, right? I own them both. I think they're both there. I'm probably a little bit more weighted in gold than I am in Bitcoin. but that could change too, right? I want to kind of see how it develops. I can't listen. Investing is not static, right? It's very dynamic. You may not be changing your mind every day, but you're following the trends, right? You're trying to understand where the money's going. You're trying to understand. You want to skate to where the puck is going, not to where it's been. And so you always have to have that conversation. So things like gold. I think because I also think because it's so underperformed this year, and it looks like it's building a base, and because what I think is going to happen next year in terms of market turbulence and inflation turbulence and all that some of your money should be in gold. Now, that may be an old-fashioned view, but you asked me my opinion, and that's what I told you.
No, it's a perfect opinion. I totally agree with you. Just you mentioned this inflation runway. Do you think inflation will persist in next year? Is it even possible? I mean, the hikes will probably happen, right? But will they work? I mean, the economy is like overheated. But when you have supply chain disruptions, what can rate hikes do?
Listen, there's a lot to unpack there, right? Because you threw a lot at me.
Yeah.
But here's the deal. Do I think I think that the Fed is behind the 8 ball. I think they waited too long, and now I think they have to run and play catch up, right? Which is part of my fear, because in order to run and play catch up, they're gonna if they're gonna start to hike rates, they may have to hike them in larger moves than what the market expects, right? Right now, the market expects quarter-of-point rate moves. There were people on Monday and Tuesday talking about 1/2 and 3/4 of a point rate moves in one move. And that's the part that gets me unsettled. Now, look, and I said this in my note on Wednesday, right? Sometimes it's good to be a dinosaur, because I remember what happened in 1978, 79, 1980, and 81 when inflation spun out of control. The economy went into a tailspin. Rates went up to 21%. Unemployment shot higher, and inflation was running at 14.7%. Now, I don't think inflation is going back to 14.7%. Let's just make that clear. But inflation for 10 years was 0. Suddenly, now we're going at 6.4%. And my sense is that because I think he's behind the 8 ball, I think it's going to persist. Do I think it's going to go to 10%? I hope not. But I don't think it's going back to 2% the way that the Fed is estimating or suggesting that that's where it's going. I think in all of 2022, inflation is going to be the story, and it's going to be persistent. And so therefore, rates are going to have to go up, right? Rates will go up, based on what the Fed said the other day in the dot plots. They expect 3/4 of a point rate increases 2022, plus another 3 in 2023. And if that's the case, that'll get us to about 1.5%, which I think is bullshit, because I think it's going to be more than, I think they're going to raise them more than that. I think the dot plot is wrong. And I think as inflation remains steady, that they're going to be forced to have to push rates higher, right? They're assuming there's going to be 3 and 3 at 1/4 of a point basis points, because they're saying inflation is going to come down. I'm saying inflation is staying up. And so if inflation stays up, then the Fed's going to have to react differently, right? Now, listen, don't forget, it's also an election year next 2022. And this country is a midterm election year, right? So congressmen and senators are up for grabs. The president, no, but congressmen and senators are up for grabs. And so it's also a sensitive year because of elections, right? Certainly the Democrats don't want the Fed to do anything too drastic because they don't want to send the economy into a tailspin. But the Republicans would love nothing more than the economy to spin out of control and inflation to spin out of control that they can then point to, the Democrats. And so there's going to be this game, this little dance that's going to be played all year next year. So get ready for it, because that's what the story is going to be. This dance between the Republicans and Democrats and the Fed and policy.
Yeah, but just last point regarding inflation. I mean, if the calculation would be the same for CPI as it was when Volcker was in the office, it would be like 14-15%.
It would be, yeah, it would be at least greater than 10%. I think it was last I heard. It was going to be, I think it was closer to 11%, but maybe you're right. It might be 14%. Yes, and that's correct, but it's not calculated that way, right? They make adjustments for it and all that stuff. And my fear is if it starts to remain persistent or starts to even elevate from there, they'll change the formula again to bring it down. They'll just rewrite the rules, right?
Yeah.
So you got to take everything with a little bit of a grain of salt. But that doesn't mean anybody here should be. I'm not lighting my hair on fire and telling everybody get out. I'm just saying understand what I think the environment is going to be. And so if that means value is the play next year, then that's what it means, right? Value. There are some great value stocks out there. Yeah, they're not sexy. They're not like, they don't give you a rush of adrenaline every single time you look at them. But in a turbulent environment, they'll offer you some safety and some stability, and that's going to make you sleep at night.
Especially, I have two. If we now go on, and I have two questions for you. First of all, which markets do you suggest? Which markets are you following for next year? And second one, is cash a position for you now at this moment? Do you building a war chest of cash? Maybe?
No, I have a 5%. I stay right around 5% cash as a percentage of my portfolio. Now, that's right now, right? Now, if I sense in January, and you'll get a sense early on in the year, how turbulent you think it's going to be, I may then start building a bigger cash position, which doesn't mean I'm going to sell anything, right? Because I'm a long-term investor. I'm not a day trader. And I own Apple because it's the thesis. Just because Apple falls in value doesn't mean I'm going to panic and sell my Apple. Why would I sell my Apple? I'm not selling my Apple. And anything, if it gets weak, I'll buy more. Because it's Apple, it's not going anywhere. But would I do the same if I owned Zoom? Maybe not. I'd probably throw my Zoom right out the window. But I'm not throwing my Apple or my Microsoft or my Amazon out the window at all. I find those as core holdings, right? But I would take new money, and like I said, I would direct it more towards value plays, right? But no, I'm not building up an extra large war chest. I got about 5% in cash, and that's kind of about where I stay because it allows me, if the market has an outsized move to the downside, I got cash available that I can go boom, boom. But okay. No, am I building up a 10 or 15% cash position? Absolutely not.
Okay, but since you said about value, how do you see China? Do you think China is a value play or
I wouldn't put money in anything in China to save my life. I wouldn't buy a Chinese stock. When they talk about China, I close my ears. I don't pay any attention. Why would you risk putting money in a Chinese stock when at any moment Xi Jinping can change his mind and send the stock into a tailspin for no other reason than it's him saying, screw it. I'm changing the rules. That's bullshit. So no, I'm not in China. I don't invest in China. I don't invest in Alibaba or any of the other ones. There's too many other places in the world to put your money. And I am not a China fan at all. You can talk to me till you're blue in the face. I'm not listening because I just won't go to China right now. Europe, there's huge opportunity in Europe. And I actually think there's going to be opportunity in Europe next year that might actually rival opportunity in the United States. But China, absolutely not. I just shut down when people start talking about China because it's not a place I'm putting my money because there's too many other places in my mind to invest your money rather than try to put my money in a Chinese stock with government regulation that you never know what it's going to be from day one to day two. And so why? Why risk it? Why not sleep at night? Why have to worry about that shit? Absolutely not. I think, and listen, you do what you want. Maybe people thrive on the fact that it is like that and it's volatile and it gets their blood boiling. Great, good for you. But I'm 60. Screw it. I am not playing with China. Just not.
Okay, just one question regarding sentiment. Do you think the listing will happen from American exchanges? The listing of Chinese stocks.
Well, you can already start to see it. I mean, China demanded that DD delist from the New York Stock Exchange, right? And it is. It's moving to Hong Kong, whatever. Fine by me. Don't let the door hit you on the ass on the way out, as far as I'm concerned, right? So whether or not China demands that they delist, let them demand they delist. I think that goes right to my point if they demand that they delist, number one. But number two, it's almost offensive to me that we list Chinese stocks in on the New York Stock Exchange in America, just because I oppose everything that they do in terms of their government, their regulations, the way they control the news, the way they control the companies, the way they'll change their mind at any moment, change all the rules and regulations, and so it makes no difference to me. So whether they delist or not, I hope they do delist. I hope they do, but I have no opinion. I have no real opinion on it, right?
Okay, since you mentioned European markets, do you have some specific country or sector in Europe that you're interested, or do you think it's interesting?
No, so when I play Europe, because I'm over here and not over there, I'll play Europe broadly, right? I'll play. I won't play individual countries unless, of course, there happens to be a story or an idea or something that pops up. But otherwise, I'll play it broadly through funds and ETFs in terms of how to play Europe across the board, right? That's where I've had the most success with the money that I've invested in Europe. But look, Europe is about 15% of my portfolio, right? It fluctuates between 10 and 15%. I'm moving it up to 15% now because I do think that Europe is going to be there's going to be opportunities across the board. But I'll play that via funds and or European ETFs. I won't play it in an individual name. I'll play it more where I get kind of broad exposure to Europe in general, right? In the States, because I'm here and I know it, I live it, and I know the products, I use the products. It's easier for me. It's easier for me to pick U.S. names, right? If I want exposure to Europe, I'm going to let somebody who's smart in Europe pick my stocks for me in Europe, as long as I do my due diligence on them and let them do their work.
Perfect. Okay, so there is one topic, since we were speaking about value before. We have to go into fossil fuels and especially energy. What do you think about that? We have quite a big problem now in Europe regarding fossil fuels, with natural gas and Russia and Germany disputing regarding Nord Stream. Can we expect also? You got democratic administration last year that was opposing fossil fuels. Can we expect U-turn after this winter on fossil fuels and especially oil?
Listen, I don't think the demand destruction story that they're trying to sell everybody in oil is happening. I don't think they're destroying demand at all. I think as the global economy wakes up, as the U.S. economy continues to move along, as the European economy moves along, I think there's going to be demand for fossil fuel, oil, and all that stuff. Now, I'm not suggesting at all that we shouldn't, as a world, start to move away as best we can from fossil into renewables, right? Yes, but I think that's at least 30 years away. It's not happening tomorrow. So let's be honest, right? So demand for fossil fuels is not going away right now. So stop the bullshit. You can't run your country on wind and solar. You just can't. And so therefore, this idea that, the administration right away, is anti-fossil fuel, anti-oil, regulation against oil, slowing down oil production in this country. And then what does he do? He gets on his hands and knees and he begs the Saudis, please produce more oil. It's bullshit. We have so much oil in this country. Remember, under the last administration, we were a net exporter of oil. And today we're dependent once again on the Mideast because of his policies. Well, guess what? I think that will change, because I think I think it's going to change in the sense that we're going to get the midterm elections and then we're going to get the presidential election in 2 more years, and I think there'll be some change there. And I'm not suggesting at all that we go backwards, but what I'm suggesting is you can't go from using fossil fuels as the main source of energy to suddenly just cutting it out and saying, okay, use wind and solar. Doesn't work like that. Right? Doesn't work. We don't have the infrastructure for wind and solar. Oh, it's great. Electric cars. That's great. Go to New York City. No place to charge them. I come down here. I live in Florida. Where am I going? There's not charging stations on every corner. And so therefore, it's physically impossible to say, okay, let's just move. There has to be all this infrastructure work, which I fully support, but it's going to take decades to do. It's not happening overnight. And so therefore, I'm bullish on oil. I think oil is going to remain somewhere between I think this year I was looking for $80 by the end of the year. We're low 70s right now. We might get a push in the next week and a half. Goldman came out today and they said they expect oil to go to 100. Of course they do. It's Goldman. right? And so, but I do say that I think oil is going to see 80 before it sees 60 again, and I think oil is going to find its kind of chi right in there between, say, 70 and 90. That's kind of where I think it's going to churn for a while. But I do think, but I think there's plenty of opportunity in the oil names too. Because look, a lot of the oil companies, Exxon, Chevron, they're pivoting also into, guess what? Oh, renewables, right? So yes, they're still the core of their business is still oil and energy and natural gas and all that stuff. But they're also pivoting and getting ready into the future to go into renewables, whatever it is, solar, wind power, whatever it is, they are moving in that direction. And so therefore, there's still opportunity, right, in those names. Again, I like the energy names. I'm invested in the energy names, but energy doesn't, to me, energy does not just mean fossil. Energy does mean renewables, but by investing in ExxonMobil, I'm investing in both fossil and renewable in one fell swoop. So I'm not anti-renewable at all.
No, I understand, but interested in nuclear or maybe in uranium place or something like that?
You know, I guess you're always interested in nuclear. It's so funny because it kind of feels like nuclear is falling out of the conversation, right? Every time people talk about energy, they're talking about wind and solar and oil. Like people are not talking about nuclear the way maybe they were, a decade ago. But yeah, nuclear power, I think, is fine. I think nuclear power is very clean. I think it's, it's clean. It's dangerous and it's clean, right? I mean, it's both. But it's funny you say that because I don't own any stocks that would be considered nuclear power.
No, because I know that this Sprott physical trust will be listed in United States. It's now listed in Canada. I'm just asking anyway.
I don't know what's the name of it.
Sprott physical trust for uranium, but we can leave it aside. It was just a question. Maybe for this market chat to go to leave it behind us. I have two questions. Since we are a trading platform, I'm asking every guest. So if you would have to choose between SPY, Nasdaq, and Russell, which index would you choose for 2022?
I don't think you want me to choose one.
Yeah, you can make a list.
Because listen, those three represent the total of the market, right? You got the Russell, you got the Nasdaq, and then you got the S&P. Forget the Dow because the Dow's only 30 names. So the Dow's great, it's historical and it's legendary and all that stuff. But who's really paying attention to the Dow? I'm not. I mean, it's nice to say, oh, the Dow went up, the Dow went down. Great, right? But
Russell is looking interested, right?
They're all looking interesting. I think if the Nasdaq corrects by another 12%, that's going to be interesting, right? I think you have. Listen, I think it's a great question, but so much depends on what happens, right? In terms of the market, if we get the turbulence, I think we're going to get in the new year. I do think that the Nasdaq is going to get hit the hardest, and then I think it'll be the Russell, and then I think the S&Ps will get hit the least. They'll all get hit, but I think Nasdaq will get hit the hardest. Now, that being said, then there'll be huge opportunities in Nasdaq, right? If it settles down. Because look, the market, the one thing the market doesn't like is the uncertainty about policy, about interest rates. Once there's clarity on what the policy is and what the interest rates are going to be or what the program is for interest rates, the market will adjust. The market will find its balance, and then the focus will turn back once again to individual names within industries based on what the new environment looks like from a monetary perspective, as well as a political perspective, as well as a regulatory perspective. So you can't, I could answer the question today and be all wrong tomorrow if suddenly, Washington, D.C. forces through that plan and raises capital gains taxes and raises it, it'll change. So it's kind of a fluid conversation. So that's why it's all dynamic, right? So I prefer not to say I would pick just one. It depends on the environment. Right now, I would say that's how I think they're going to get hurt. Nasdaq mid cap and then S&P.
Yeah, no, but that's a good answer. I mean, maybe we should just wait for a possible correction and then buy Nasdaq. I mean, this is a viable strategy that
Listen,
we're also thinking
and we
about.
already discussed it. There's a lot of names on NASDAQ now that are down 40 and 50%.
Mm.
Now, I think you got to be careful with the next 2 weeks just because it's the year end and just because there's a lot of year end tax selling going on, which in fact may be the opportunity. Because there's so much tax selling going on, these stocks are down even more. Suddenly in January, you look at a stock that's down 60%, you go, holy shit. Because the story hasn't really changed there. If COVID continues to cause chaos around the world, there's going to be opportunity there. So I think you just have to be dynamic, right? You have to be dynamic. You can't be, investing is not about being static. You don't just pick one stock or two stocks or three stocks and then walk away from it because the story changes, right? So you have to be a little bit more fluid and dynamic. Maybe not every day, unless you're a day trader. Then if you're a day trader, you're there every day because that's how you make your money. So OptimTrader, you guys are there every day. You want to see the chaos. You want to see the volatility. Listen, but they do it over here too. The same day traders over here want to see the same thing. So I get it. But that's not who I am, right?
No, but I totally agree. Maybe even we are expecting, like, if something will happen in January, maybe Nasdaq will be the most interesting to buy. I mean, that can be a good strategy.
Yeah, I think you have to at least start looking at some of the names in the Nasdaq interest, and you start making your shopping list, right?
Exactly.
I do think you don't rush into it right now because I think the next 2 weeks could see more volatility just because it's the end of the year, and so you might get action based on for a number of reasons, right? People that portfolio managers now, as we move into the last week and a half of the year, portfolio managers are going to be window dressing their portfolios, getting them ready for what they think is going to happen next year, weed out some of the losers. And so you might get extra pressure in some of these names, which means all that means is get your list together, keep your eyes on them, and get ready to pounce when you're ready in the new year.
Yeah, perfect. I totally agree. I totally agree with this strategy. So Kenny, thank you very much for all this market talk. But there is one thing that I have to ask you because I'm following you and I see that you are a very very passionate chef. So you love cooking. So since Christmas is coming, do you have any suggestions for our clients what to cook?
I always have a suggestion about what to cook. I mean, I'm never at a loss for words when you talk about food and cooking. But look, you follow me, right? So you get my blog every day. My blog is on my Twitter account. It's on my LinkedIn account. You can find it. It's out there. And every day I give you my market commentary. And then at the end, I give you my recipe of the day, right? I feed you something real every day, whether it's pasta, chicken, fish, pork, whatever it is. Could be vegetarian, could be whatever, right? Risotto, whatever. They tend to be more Italian because that's how I cook. But I started on December 1st in my notes because as many of you might know, I'm assuming a lot of you know because you're over there in Europe, and so maybe you understand, but there's this Christmas Eve tradition about the 7 fishes, right? So on Christmas Eve, in my family as a kid growing up, and a lot of Italians in this country that come from the South, Christmas Eve is all about 7 fishes. You don't eat meat on Christmas Eve. And so therefore we cook 7 different kinds of fish. And why is it 7 and not 8? I have no idea. That's the legend. You can figure it out. I don't know, 7 sacraments. You could, whatever, however you want, right? One way or the other, it's 7 different types of fish. So I gave you the first 7 days in December, I gave you every recipe that I'm going to cook on Christmas Eve, right? So it's linguine and lobster sauce and a nice tomato sauce. Oh my God, but you have to have Maine lobsters. You guys can't get Maine lobsters unless you ship them in, right? And then there's stuffed calamaris. You could probably get calamaris over there, right? But you stuff them and then you put them in the tomato sauce. You can mix that with the lobster sauce and put it over linguine. Oh my God, it's delicious. And then there's filet of sole done Italian style with the breadcrumbs broiled under the broiler. There's baked and broiled salmon. There's a black truffle bay scallop dish with Brussels sprouts that you can put over pasta in a truffle cream sauce. There's feta shrimp, which I make shrimp with feta cheese and Roma tomatoes and garlic and shallots. and some Madeira wine. You can eat that way. You can eat it with garlic bread. You can put it over rice. You can put it over pasta as well. I'll make mussels Pasillipo, right? So mussels in white wine and broth and some hot pepper and some clam juice, and then a touch of tomato, and then garlic bread, because you need the garlic bread. I don't know. You can find all the recipes there. And now I'm starting to give you the desserts, because after the meal, then you have to have a beautiful dessert table. So today I gave you my grandmother's cheesecake, which is delicious. And I gave you, the day before, I gave you her butterscotch clusters. Delicious. Easy to make. Once you make them and you start eating them, you won't stop. And so I'll give you more. But you can get it on my note. So give them my Twitter address, or give them my... they can go to my website and sign up for my note directly, so they'll just get it delivered to their inbox. It doesn't cost anything. It's free. I just give it out.
Yeah, exactly. That's the last thing that I wanted to ask you. Where can our subscribers, our followers find you? So you have a Twitter account, you have a LinkedIn account, you have your own webpage with morning thoughts that are really interested. So everybody that are interested, please follow Kenny Polcari. And thank you very much, Kenny, to joining us in our live session. And I really hope that this is not the last one, so we can get you you back somewhere in the future.
I guess it's going to depend on the kind of commentary you got from all your followers, whether they liked it or they didn't like it. That'll determine whether or not you ask me to come back.
Yeah, I'm pretty sure they will love the talk, and I really hope that they will see you back on our YouTube channel in a short notice.
Yes. Merry Christmas. Happy New Year.
Yeah, thank you for all the listeners, and see you on Tuesday when Nikolai is having his live session about trading. So that's it. Have a nice weekend, and bye-bye.